Greetings from Chartered Accountant Bhavik Dholakia. I am extremely delighted to have been entrusted with the task of dealing with this February 2021 edition of BCAS Tax Gurukul. So the topic for today's Tax Gurukul is set off and carry forward of losses. However, we are not going to go into the niceties and nitty-gritties of the tax provisions relating to set off and carry forward. We shall only deal with the due date perspective of the provisions of set off and carry forward of losses. So we all know that under the Income Tax Act, the tax is on total income of the previous year from various sources to be computed separately. So if suppose a person has only one source of income, that becomes his total income. However, in most of the cases, a person may have various sources of income under various heads of income. So what under the Income Tax Act is taxable is the net result of the sum total of income under various sources of income and heads of income. And while computing this net total income, we have to take care of the commercial principles which are to be applied in computing the total income. That is, income is profit or surplus of receipts over expenses or outgoings. So in that case, if the receipts are in excess of the expenses or outgoings, then there will be profit or surplus. And when these receipts are less than the expenses or outgoings, there will be loss or negative income. The moot question therefore is, what are the provisions under the Income Tax Act, or how does the Income Tax Act deal with this situation of losses or negative income? And we are all very well acquainted, being chartered accountants or tax consultants, with the provisions which deal with set off of losses and also deal with carry forward of losses. So this understanding of computing the net total income or total income on net basis is absolutely rational, reasonable and digestible. However, under the Income Tax Act, under the specific provisions dealing with the treatment of losses, the set off of losses and carrying forward of losses, the methods, norms and restrictions are provided. So when you look at those specific provisions, you come to know that not every loss can be set off against every income. And to know what kinds of losses can be set off and what kinds of losses can be carried forward for setting off against the future income, you need to look at the chapter 6 of the Income Tax Act, which contains section 70 to 80 and that deal with the situations where losses to the extent not set off can be carried forward and set off against income of subsequent years subject to rules. Then on taking perusal of certain other relevant sections, when you look at section 14, it will also require you to compute the total income of a person for tax purposes under various heads of income. And we all know there are 5 heads of income. Now this computation of income under a particular head is to be done on the basis of the character of that particular source of income. And we also further know that the separate rules are prescribed for computing income under a particular head of income, and the expenses pertaining to a particular head of income are allowed to be deducted from that particular head of income itself, and they cannot be allowed to be deducted from the other heads of income. So in that case, we need to conclude that this income tax is only one tax levy on sum total of income classified under various heads. It is not a collection of distinct taxes levied separately on each head of income. So if you take perusal of these provisions, you would come to know that there are various sections dealing with various situations which are in the nature of setting off and carrying forward of losses. So under section 70, you will find provisions relating to set off of loss against income under same head, which is intra head, Under section 71, you will find provisions relating to inter-head set off. Under section 72, you will find provisions relating to carry forward and set off of business losses. Under section 74, you will find provisions relating to carry forward and set off of capital losses. And ultimately, section 80 will end up telling you that the return of loss needs to be filed within the time mentioned under the provisions of section 139 of the Income Tax Act to be able to carry forward and set off your losses. And this importance of carrying forward and setting off your losses can never be undermined insofar as such a facility of carrying forward and setting off the losses preserves valuable cash which otherwise would have to be paid out of taxes, and such funds which you are able to augment because of savings in taxes, because of your ability to carry forward and set off your losses, can be used in your own business for working capital and or for the purpose of expansion of fixed asset or other non-current asset. So thus, having known the basic provisions or recapitulated the basic provisions relating to losses, set off and carry forward, one would finally realize that the filing of return of losses is very, very important, and it cannot be missed out. You cannot file your loss return not within the due date mentioned under section 139 of the Income Tax Act. Otherwise, one would end up losing the benefit of carrying forward and setting off of losses. So if you then take the perusal of various other compliances and the exceptions carved out under the Income Tax Act, you will realize that this filing of return itself is mandatory only in case of a company or a firm, irrespective of their activity, irrespective of their whether the end result of their activity is income or loss, they will have to file their return. However, for other SSEs, similar is not the situation. For other SSEs, one will have to file the return only if the income of that particular SSE is in excess of or is exceeding the basic amount that is not chargeable to tax. So if one would like to take the benefit of these provisions of carrying forward and set off of losses, one will have to file its return in time, because section 72 mandates specifically for the purpose of losses under the ad business that the carry forward of such business losses will be allowed only if the return is filed within the due date mentioned under section 80. Thus, even for the other SSEs for whom if there is a loss, the return filing process or the obligation is not mandatory, but if they want to take benefit of carrying forward and setting off of losses, then they will have to file the return in time. So further, the joint reading of section 80 and 139(1) would entail that the losses under the head business and profession and capital gain, these are the specified losses. If you want to carry them forward and set them off against the income of the subsequent years, then it will have to be filed. It will have to be part of the returns filed within the due date mentioned under section 139(1). However, under these provisions itself, there are certain exceptions which are carved out, like intra-head set off and inter-head set off mentioned respectively under section 70 and 71 are allowed to be done even if the return is filed late. Then going further to the another exception, the losses under the head house property, unabsorbed depreciation allowance and specified capital expenditure would be allowed to be carried forward even if the return is not filed in time. And these propositions are also confirmed in the case of Govind Nagar Sugar Limited in the year 2011, and also in the case of by Infotech Limited in the year 2012 by various high courts. Then we may further also look at certain decisions which are supporting the SSE who had not or could not file their returns in time. They had certain losses to be carried forward and set off, and the courts had decided in favor of the SSEs, and their losses which were although not covered by the returns filed in time, where they were covered by the returns filed belatedly, were allowed to be set off. Let us look at certain such situations and let us also refer to those decisions. So that one of those cases was by the Apex Court of India. It was in the case of Dalmia Power Limited, where the revised return was filed by an amalgamated company to give effect to the scheme approved by NCLT. Now we all know that for an amalgamation the appointed date is much earlier. However, the scheme of this amalgamation is approved by NCLT much later, and by all means in such circumstances, in case of all such amalgamations which are to be approved by NCLT, the returns of the amalgamated company will not be filed in time. So, however, under the Income Tax Act, the purpose as per the Supreme Court is to assess the tax liability correctly and in accordance with the law. And therefore, in this particular case, the Supreme Court had allowed to file that return belatedly, and still the losses of the amalgamated company will allowed to be set off, carry forward and set off against the income of the subsequent year. Then in another case, B.E. Billimoria and Company, in the year 2020, the court had an occasion to consider the filing of original defective return, and which was revised subsequently after the due date mentioned under section 139(1). And in this case, the original defective return, whatever was the defect, was cured, and then the court had held that the return will be valid and the losses were allowed to be carried forward and set off against the income of the future year, although the revision was not done within the due date. Then in the third case, which was of Luxury Goods Retail Private Limited, Mumbai Tribunal had an occasion to consider a very peculiar circumstances where return was not filed electronically due to technical reasons and it was manually filed, however within section 139(1). And the contention of the SSE was that at the most this return may be considered as defective but not invalid by any stretch of imagination, and the court had, even in such circumstances, allowed the carrying forward and set off of losses of this company against its future income. Then the question may also arise that whenever such restrictions are imposed on certain benefits or reliefs under the Income Tax Act, similar to this, whether the act itself provides for any remedy. Yes, under section 1192B, the remedy is provided, and it takes care of the principle of natural justice, where the grounds of reasonableness, genuine hardships and exigencies beyond the control of the SSE are given due respect. So the SSEs who have not been able to file their loss returns in time may approach the highest administrative authority, that is CBDT, who is empowered to act under section 1192B to issue a general or special order to allow claim for exemption, deduction, refund or any other relief. And this phrase, any other relief, would cover this kind of a situation where the loss return was not filed in time, and the CBDT will be empowered to deal with such kinds of applications on merit. And even if a loss return is filed belatedly, the CBDT will be able to condone the delay in filing belated loss return and may the SSE get the relief on merits and may be able to carry forward the losses on approval of such an application. However, when you take the perusal of the provisions of section 1192B, you will find that this genuine hardship is very important, and courts had various occasions to consider what set of circumstances will be considered as genuine hardship and what set of circumstances will not be considered as genuine hardship, and what will be meritorious applications or what will be non-meritorious applications under section 1192B. So let me now give you some of the examples of circumstances or set of circumstances which were considered by various courts as genuine hardship, and therefore these SSEs who were suffering from these genuine hardships were allowed to carry forward and set off their losses irrespective of the fact that they were not able to file the returns in time. So one of those circumstances was delay in audit by auditor appointed by the registrar of a cooperative society. So the delay was absolutely not within the control of the SSE. It was absolutely within the discretion of the registrar of the cooperative society to appoint the auditor, who was belatedly appointed, and therefore because the audit was belated, the return also could not be filed within the due date. Then in another case, there was a serious cancer ailment that affected the infant daughter of the SSE, and therefore the SSE could not file the return. Then on still another case, on account of sudden crashing of computer system, the SSE could not file a loss return in time. Then in very peculiar set of circumstances whereby the SSE's elder brother was sitting in a car and the car was swept away by flood, and the SSE had to rush to the place of such flood where the car was swept away in search of the body of his brother, and the circumstances were allowed to be considered as a genuine hardship for the SSE's inability to file its return. And in case of a business which had suffered severe financial crisis and several court cases, the court also had taken a lenient view and allowed the SSE to carry forward and set off its losses against the future income, irrespective of the fact that it had not been able to file its return in time. We may also make a passing reference to the provisions of the recently introduced budget 2021, wherein this time for filing your belated return under section 139(4) and your revised return under section 139(5) are now reduced by 3 months. So as per the existing provisions, the SSE can file their belated or revised returns within 12 months from the end of the relevant assessment year, or before the completion of assessment, whichever is earlier. So to give you an example, for the assessment year 22-23, presently we can, as per the present provisions, we can file the belated or revised return before 31st of March 2023. However, this period of 12 months has been proposed to be reduced by 3 months, and therefore now one will have to file the belated or revised return in case of assessment year 22-23 before 31st December 2022. So that was all from my side on the topic entrusted to me. Thank you very much for a very patient hearing, and we hope you like this short videos. The team BCAS Tax Gurukul would love to receive your feedback on their email address bcastaxation@gmail.com, and this PPT should be available in the description tab. Thank you very much.